great material here for you today. I want to discuss some innovations we've had here at Discover Options, new research and strategies. But before that, just a little note here that presented material today is for educational purposes only and should not be construed as personalized financial advice. And any past results are not necessarily indicative of future performance. So again, welcome. Some things that we've done here, I mean, we've been in business, Discover Options is a subsidiary of OptionVue Systems International, which is the creator and provider of the highest end options analytics that you can obtain, aside from being within an institution like Goldman's, but for the trading public, if you are an advanced options trader, then OptionVue is the ticket in terms of having the highest end analytics available. Discover Options is the educational arm of OptionVue, and we've had a mentoring program here for about, I'd say about 10 years or so or more, and we've made some enhancements in our equity track mentoring program. It's 14 classes, and I want to talk to you about two of those courses that we've replaced with some innovations that I think you'll find very interesting in the area of trading index options. First off, in session 9 here, we have proper entry and timing of SPX Condors and Butterflies. And so I'm going to today present to you a portion of that course, just to kind of show you, a little bit about Condors and Butterflies, but in particular, give you an outline in terms of how we determine entry for the SPX Condors and Butterfly strategies. It's innovative. No one's really talking about it. Quite often, folks are using seasonal entries, maybe the second Friday of the month, or third Friday, or this Thursday, or maybe this Friday if it's a down day, or whatever. It's typically a seasonal approach because what's pitched to you is that you can obtain regular income. Well, regular income cannot happen unless you're always in the market or in the market a lot of the time to represent that you're going to get regular income on these strategies. Well, we have made some enhancements in terms of using price action, technical analysis, if you will, to help us determine favorable entry points versus unfavorable entry points for Condors and Butters. Okay, and then the other class I want to show you a little bit that we've done here, some enhancements, is in the area of hedged bull put spread campaigning. And this is a wonderful strategy, and then we're going to go over a little bit about that. Even there we use timing, but I want to explain today just the mechanics of that and kind of just show you a little bit about the direction that we've headed, which is a bit different than you'll find in other firms teaching options trading. Okay, and so we have some wonderful staff here with our mentoring courses that will help you get up to speed in all of our courses, and so that's what we do here at Discover Options, and we have a full array available at discoveroptions.com. Let's talk first about the first course that I presented there, proper entry timing of SPX Condors and Butterflies. Now, before we get to the timing part, I want to review, and maybe some of you aren't familiar with Condors and Butterflies. I think a few of you might be already advanced traders just wanting an extra edge. That's great. But I'm just bear with me here while we just do a brief review of what Condors and Butterflies really are in the SPX. And so here's an example in OptionVue of a Condor strategy. And so let me just walk you through this real quick, and let me set my microphone up differently. One moment. Okay. Normally I hold this, but I'm going to do a little more typing than normal here. So there we go. So what we have here is in OptionVue, this is what we call our matrix. We have the call options on the top, the put options underneath, and then moving left to right, we have the expirations moving further out in time as we move from left to right. Now this is the way that OptionVue lays out the option chain. This varies greatly from many brokerages when they provide you their free analytics. Quite often, it's coming from the standpoint of an on-the-floor market maker where you'll have calls and puts in a column, calls on the left, puts on the right, and then a big long column with the near months at the top and the distant expirations down at the bottom. Well, that's great if you're trading boxes and strategies that a market maker would use. But for an off-the-floor trader, we have found, and OptionVue was designed by a very proficient off-the-floor trader, Len Yates, our founder and president, laid this out as a way, as being kind of like a chessboard, so to speak, that we could conceptualize options, and now we can see relationships in a much, we feel, a much better way in terms of horizontal skew and vertical skews, the implied volatility skews. And so that's how we lay out the option chain. We found it to be very, very good for off-the-floor trading. So what you're seeing here in a Condor is a credit spread in the out-of-the-money calls. If the SPX was at 2153, here we're out of the money at the 2220s, selling an option there at the market price of 433, and then buying the next one out for a net credit. So this is called a credit spread or a bear call spread. At the same time, we go down into the puts, and we do a similar type trade where we're selling an option in the out-of-the-money puts, and then buying a contract further out of the money, in this case 20 points away. It's a little bit, it's a 20-point spread versus a 10. Okay, this is a Condor. A lot of times people want to make it the same width, and that's fine. Just understand that if you're trading Reg T requirements, it's going to look at the farthest width out here, the 20, to calculate your gross requirement. So what we're doing here is that we're bracketing the current price of 2153, and as long as the market stays between 2000 and 2220, all right, if it stays there and it expires in 33 days within that price range, then we'll collect the full credit from both of the spreads. Now, certainly we do not advise you to just put this trade on and close your eyes. We advise you to have a good strategy of rolling profits and taking losses and rolling those out, and we certainly teach that in our mentoring approach, in our mentoring course. But this is just the base Condor. And when you do a graphic analysis of this, this is the picture that you'll see. Now, again, some of you advanced folks, you know exactly what this is, but for the folks just starting out, let me explain this very, very quickly. What you're looking at is a graph showing you at the x-axis at the bottom the price of the SPX. As we move up, we move to the right. As the SPX goes down, we move to the left. And then we can see then the actual profit and loss delineated by these blue lines. And here is the zero break-even line. Any line above this is profit. So we can see at expiration that if we collect the full amount, and that's 33 days into the future, then we'll collect roughly, well, what did I say? Looks like about, what did I highlight there? Oh, I don't have the yield. It looks like about a 17% yield on our net requirement. Okay. Now in OptionVue, we also have very accurate T plus lines, T plus 0, and then the midpoint T plus 17, showing you very accurate theoretical prices and theoretical profit and losses at these different time frames between now and expiration. Okay, so that's how you read these graphic analysis. And now what you'll note is that at expiration, and even in the middle here, T plus 17, you could make money even if the market goes up or down. You don't have to, you're not limited only if the market goes up. And that's the big draw in some of these types of strategies. Now, here is a price chart with a profit region, and I'm depicting to you the profit region of a long stock position or simply a long SPX position, so your spiders, futures, whatever. Typically, a long position in an equity or an asset means that you'll be in the green zone if it moves up. all right, and you're going to end up losing money if it goes down. Now, when we look at the profit zone of this Condor strategy, it's a bit different. Remember, I'm showing you here that you can make money if the market goes up or down, so long as it doesn't move out here where you're underneath the zero break-even line. Likewise, if the market goes down, you could still make money all the way down to whatever that short was, 2,000. But anything beyond, what, 1990 or something like that, then we start losing money here, being down. So how is that going to look here when we look at this profit? And instead of the long position, just straight long, here's what you have. In a condor or a butterfly, this is kind of the feel that you get, in that you're going to be in the green zone, even if the market goes up or down. You don't have to really predict, so long as the market doesn't move too far and too fast, such that you get into the red zones down here or way up there. That's where you can get in trouble, is if the market moves too far and too fast. So this is the huge draw behind option strategies like Condors and Butterflies. Here's a butterfly strategy. Let me get a sip of coffee here. It's early in the morning. One moment. So this is what we call an iron broken wing butterfly, or broken wing iron butterfly. Several different types of butterflies. This is just one. But the notion here typically is that you're selling premium at the at-the-money call and the at-the-money put. And then these are basically two credit spreads glued together with their short strikes at the same value, contract strike price, in this case of 21.50. Two credit spreads glued together with the shorts at the same strike price. That's what you have here. So in the puts, we're selling this put for 34.82 and buying this one for 16.23 to cover it, so to speak, so that we don't have a naked short option. Then in the calls, we're selling this at-the-money call of the same contract as the put, and we're going out less distance, thus making it a broken wing butterfly, but we're selecting the option with the call with the correct delta to make us as close to delta neutral as possible. So when we graphically analyze this, the T+0 line is as flat as possible. That means we're delta neutral, so to speak, although, rarely are you exactly at a delta of exactly zero. You're leaning one way or the other. In this case, we're leaning long just a little bit. But what you're seeing here is the similar spirit of the Condor, where we can make money if the market goes up or down, so long as it doesn't move too far and too fast and get us into trouble here. An advantage of the broken wing butterfly like this is that you can make it such that if the market does go up too far and too fast, look at this, you're really not going to lose that much. In fact, you can make it so that you're making a few bucks, and you could technically be above that zero, so when you analyze it, you still make money, and you'll have a green section all the way. Here I think we're just a few cents below. So indeed, that's true. If the market goes down too far and too fast, we're going to lose just a little bit of money down here, not near as much. Or excuse me, no. It's the other way. If a market goes up, we're going to lose a tiny bit amount, and if it goes down, well, then we can get in trouble. So on the upside, we won't lose it. You can kind of see it's kind of lightly shaded orange. Down here, it gets deeper orange the further out we get. So what you'll see here is a common theme, in that so long as the market doesn't move too far and too fast, we're going to do pretty well. We'll be in the green, and our challenge now is to find through technical analysis, through price patterns. My quest for the last 2 years has been to locate those periods of time where we're more likely to encounter a choppy market like this, where the market, wouldn't it be nice to have this kind of choppy market entering this kind of trade so it chops right into that green area there? On the other hand, we want to avoid periods like this where it can really fly off the handle and get into the red zone. So how can we use price action to try and determine the likelihood that we'll encounter these choppy markets versus these crazy markets. That's been my quest. I'm going to show you a little bit about where we've gone here, and hopefully it'll be of some help. So, two concepts to kick this off in terms of timing the entries of your butterflies and condors. Two concepts involves volatility, and there's two types of volatility that we discuss. First, in the blue line, we're reflecting the volatility implied by the option prices. Implied by the option prices. You know, going into a huge event in the world of earnings or whatever, the options get extremely expensive because there's great anticipation as to that earnings event coming out. Likewise, after the event, the options get very, very cheap because the event is past and the waters are calm again. In the indexes, it's a little bit different. Typically, when the market begins breaking down and there's the threat of anxiety of people getting anxious about the possibility of a crash, well, then the options get very expensive. The put options especially start getting expensive because the institutions and heavy investors, they're going to the put options to ensure their long portfolios. So when the market begins threatening a rapid downward move, those put options get expensive, and hence the calls do also. All right, and you'll see the implied volatilities rise. Okay. Likewise, when the market begins going up in a bullish market, the waters are calm again. The threat of a crash, so to speak, goes away. Then you'll see the blue line, the volatility implied by the option prices goes down. Okay, so you see an inverse relationship in the SPX between the SPX going up, implied volatility coming down, and then it goes the other way. SPX goes down, you'll see the blue line, the implied volatility rise. That's the blue line. Now, the blue line is reflecting a prediction of the future, right? The option prices are a reflection of what the option traders think that the future holds. Okay, now the red line is something different. The red line reflects statistical volatility, or what others call actual volatility, or even historical volatility. In OptionVue's volatility chart here, the red line is reflecting the volatility of the past 20 days. The past 20 days. So if you remember the market moved downward at the beginning of this year in January, remember how the market, right at the beginning of the year, I think right after New Year's, boom, market started going down. Well, the statistical volatility began climbing, and you can see that red line beginning to go up there. Also, the blue line was rising as well. The implied volatility was rising. All right. Now, a lot of folks, what they'll do is they'll look at this chart and other charts like it, and they'll look at the difference between the blue and the red and make some sort of conclusion that the market that the options are overvalued or undervalued. But you can't really do that here, because really the red line is measuring the last 20 days. It's a measurement of the past. Yet the blue line here, what is it doing? It's measuring a prediction of the future. So you're really looking at apples and oranges here, aren't you? So we have to just keep that in mind as then we go about trying to find markets in a market environment that is more apt to mean a lower market volatility. We don't want the market to move much, right? We want to find those instances where it's calm, or is more likely to be calm, or less likely to be wild. All right, that's what we're looking for. But we have to understand these volatility levels. So what I'm going to do, and here's a screenshot from our mentoring course. I'm going to go over the first two in a bit of detail here. I want to understand the implied 30-day move, understand the actual 30-day move, and then how we assign, in retrospect, bars that are favorable versus unfavorable. Okay, and this is straight from our course that you'll see here. Let's first understand an implied 30-day move. So here's what we do. We take the VIX, that's at the bottom of the screen here, and that's published by the CBOE. It's a compilation of the SPX cash options. It's a running 30-day implied volatility number. How much volatility is implied for the next 30 days by the SPX options? And you can go on the CBO website and get the white paper and look at the math and everything, but they publish a VIX for 30 days. I think they have a 9-day VIX and maybe, what, a 90-day VIX, something like that. We're looking at the 30-day VIX, 21 bars. All right, now, I want to show you this skew. This is an important concept. You have the VIX here. It is a single number coming from the calls and puts in the VIX, but when you go to the options in the SPX, and you look at what we call the implied volatility, the MIV, the implied volatility of the market price, which is basically in between bid and ask, the volatility implied by that time premium varies from strike to strike. See that? And in the SPX, what you'll find is that when the market begins going down, those out-of-the-money puts get very expensive because people are rushing to buy those as insurance, right? And then through various trading relationships, it then has an effect on the rest of the options. And so what you'll see then is these out-of-the-money puts have much higher implied volatilities than, say, the out-of-the-money calls. All right? So when we look at these SPX cash options, and we ask ourselves, well, what move to the upside is being implied by the SPX cash options? We would look at these and say to ourselves, okay, these out-of-the-money calls have a much lower implied volatility than these out-of-the-money puts. All right? So we can't just take the VIX and ascribe it and say that it's implying an upward move of X percent and a downward move of X percent, those both being the same, because in the SPX cash options, in reality, the options and the calls are implying a different move to the, a certain level of move to the upside and a much larger move to the downside. Okay, it's asymmetrical. The VIX gives us one number, but the SPX cash options really are implying a certain move to the upside that is different in magnitude compared to the move that it's predicting or implying to the downside. I hope that makes sense here. So we are going to take this vertical skew and factor that into our calculations here. Now, how do we do that? Fortunately, the CBOE was kind enough to roll out this value here called the skew. I'm not going to get into details of this, but you can go to the CBO website and look at the white paper on the skew. You could look at a description here. And this is straight from what they publish. Basically, the skew is a value that is reflecting the magnitude of that vertical skew I just showed you. And it begins with what they call the tail risk. Way down there in the out-of-the-money puts, if the market were to crash, you know, how we go to the tails down here. Let's back up. Way down here, if you keep going down, way down there in the out-of-the-money puts, it's basically reflecting, starting with that, the tail risk way down there, and the skew coming up all the way to the in-the-money puts or the out-of-the-money calls as it goes. So this skew measures the magnitude of that vertical skew. Skew, this SKEW, is the symbol if you want to get it and chart it. And you can actually get this. Now I'm using Metastock, and in Metastock I can bring in the skew value. It's published by the CBOE every day. And I'm going to combine it with the VIX to come up with two different volatilities. I got the VIX, and I'm going to carve it up and derive an upside volatility level and a downside volatility level. That's what I'm showing you here. Here's the VIX, at 14 at that time. And when you run it through the algorithm that I derived from the skew, looking at the white paper, coming up with the math to make this happen, we have the upside volatility is lower than the downside implied volatility. You see that? And so we're reflecting, we're taking the SPX options and we're now using the market predicted level of movement there. Okay, now we're going to convert this to a predicted actual move. What does this mean, 16%? What does that mean in terms of a predicted move over the next 21 bars? That's what I really wanted to get to here. Okay, and so I like to take this and bring it down to the level of what is the VIX, what is the skew adjusted VIX, and I'm going to call it that now. What is the skew adjusted VIX saying about a predicted move to the upside and a predicted move to the downside? 30 calendar days, 21 trading bars. In this particular case, at those levels, the skew adjusted VIX is implying a downward move of 4.6% in this example. It's implying an upside move of 3.5%. Okay, different levels of moves there. So that is the implied move, and that's something that we have to understand. We have a different implied move to the upside versus the downside. Now, that we understand that, let's talk about the actual move, the 30-day actual move. Now, this is fairly simple. We simply look at a price chart, and we ask ourselves, now let's just take the upside move in this case. If we have a certain close, we simply ask ourselves over the next 21 bars, how far did the market move to the upside? And we take the extreme high over the next 21 bars, and we calculate the percent move that it incurred. Here we had 74 points, works out to about a 3.6% move to the upside over the ensuing 21 bars. And we can actually chart that move down there that you can see. I created an indicator in Metastock to do this. Now, it's always in retrospect, right? That's why you don't see any values here, because we have to wait 21 bars before we can actually ascribe a value here. So here's the question now. Back on March 28th, okay, we know what happened 21 days after. We know it moved up 3.6%. What were the options implying at that time? Okay, what were they implying? We go back to the VIX, run it through the skew. We come up with the fact that at the time, the implied move at that time was 3.8%. Okay, the actual move was 3.6. So in this particular case, the market did not move as much to the upside as what was being implied. See that? Okay, let's take an example from the downside. In this particular case, we had a close at 2078. This is at the beginning of 2016, who I already discussed. We could see on the downside the market moved a lot. Look at this. It went down, and at the low of that 1920, about the January 20th, it hit a low of 1812. How much of a move was that? 266 points. Works out to about a 12.8% move to the downside. Okay, you could chart it. You can see how we charted it like that. Now, what was the implied down move at the time? Okay, let's go back. We're going to look at the VIX, run it through our skew algorithm, and what we get is that the SPX cash options at the time were implying a downward move of 5.6%. Actually, the market moved 12.8. So let me ask you, was that a favorable or an unfavorable time to get in the market with the Condor or Butterfly? It was a very unfavorable time, right? So what we like to do here is we label those bars in retrospect. We're going to label those bars as unfavorable. Whenever the bars result in a move that is a higher actual volatility versus the implied, I think you'll agree. Let me get a better thing here. We're going to call this. This was a dangerous. I can't write the word dangerous. This was a dangerous time to get in for doing butterflies and condors. We had a lot of big move. In this case, to the downside. So what we do is we can look at both the upside move in actual and implied in the green here, and then we're going to look at the downside actual and implied, just like that. And what we do is we label these dangerous, like I just showed you here. Let me get my yellow. Okay, we had a danger zone here where the market moved down. Actual was much more than implied. So all these bars along here were dangerous because of that move coming up here where it really moved down. Now, you get to a place then where the implied move up was greater than the actual. We call these were safe in terms of upward moves, but also you get down here, and on the downside, these bars also were safe. Do you see that, where the implied move was higher than the actual? So wherever you have the up and the downside being safe, we're going to label these bars as favorable, where you have safe zones on the upside and the downside. If you have one side being dangerous, like here and here, we're going to label those bars as unfavorable. Now, what I like to do in Metastock is I color these bars. I color the bars blue that are favorable, that are in safe zones in both areas, upside and downside. These are blue, these are favorable. And then those where we have a danger indication, a danger zone having occurred, these are red. Now, all this is in retrospect, 21 days behind, right? But I carve this up so that I can understand then how to find, at least a good starting point for finding price action strategies to try and predict when we're going to have more blue bars than red. We want to find strategies where it's more likely that we're going to encounter blue bars than the red bars. And that's what we do here, and we've done it quite well, I believe. What do we do next? I'm not going to get into details here. I'm going to get to my next segment here on another class, but here's what we do. We determine the historical distribution of those two types of implied and actual, favorable and unfavorable bars. The question here is, how many bars in the past, and we like to go to January of 2000, because January 2000 to the present, you get about as equal of a balance between bullish and bearish markets as you're going to find. And what you'll find is that roughly there were, it's not quite 2/3, but it's basically between 60 and 70% of the bars were favorable. Okay, 60 to 70, 30 to 40% were unfavorable. All right, and so we have those exact stats, and we start that as a beginning point for understanding the SPX market. Okay, so that's what we do there. And then that's it. What percentage of all the historical bars turned out to be favorable? 60 to 70. The next thing we do is we take a look at a technical setup, and then we go back in time and say, okay, when this setup has occurred in the past, how many of those setups resulted in favorable bars and unfavorable bars? And if we can find a technical setup, I hope you'll agree, if you find a technical setup that results in 100% of the bars being favorable each time that setup occurs, well, then you have the holy grail, right? You're going to put on Condors and Butters every time that setup occurs, knowing that in the past, every time it's happened, it's been a favorable bar. I've never found 100%. I've tried a lot of technical setups, seeking those that result in a favorable bar 100% of the time, and I can't quite get it to 100. Okay, but what I can do, what we've done here, is answer this question: what technical conditions are best for placing Condors and Butters? And what we've done is we've come up with a combination of moving average and stochastics. If you're familiar at all with technical analysis, those are two tools used quite often. And we try and ascertain a set of market environments where the percentage of favorable bars varies, and in this case, we define it and we've got it down to 53 to 74%. We know that when we are down in the 50s, okay, that's far less than what the typical historical distribution is. We have a negative edge. If we're above the baseline, which is in the 60s, and we're up to 74, now we have a favorable environment. It's better than flipping a coin or doing a seasonal guess because you need income that month and throwing it on. Okay, we want to put on these strategies when we have a greater likelihood of the bars being favorable. We can't get to 100%, or maybe I can, but it'll only be maybe one signal a year. I'm not going to do that. But this is the tools we use. We teach you in the mentoring course the exact parameters, and we get into much greater detail. But what you've seen is just the setup that we've set the table for understanding how to determine the best technical setups for condors and butters, okay? All right, let me get a sip, take just a 2-second break, and then we'll get to the hedged bull put spreads. 1 second here. All right, hedged bull put spread campaigning. This is the second course that we have updated in our mentoring class. And this idea came to me. We've had some students that have settled on this strategy over the many years we've been in business. And I liken it to a golfer, in this case Dustin Johnson. He's hitting what's called a power fade. Ben Hogan started this in the 50s. He changed his swing. He kept, snap hooking the ball. He shortened his thumb on the shaft. He shortened his swing, and he just basically cut the ball down the fairway, eliminating the possibility that he was going to snap hook it. Dustin Johnson, after him came Jack Nicklaus that did the same strategy. He would hit the ball to the left side, fade it back into the fairway, but he was essentially taking out any of the trouble on the left. Okay, and he then managed the amount of the curve of the ball, but he knew that the left side was now pretty much taken care of. And likewise, we can now devise a strategy like this, where we're basically, if we're on the tee box here, let me get this. If we're on the tee box here, we're hitting the ball down the fairway here. We're executing a strategy where we're pretty much going to not worry about the upside. You remember in Condors and Butterflies, if the market went up too far and too fast, we'd have some red up here. Remember that? This is a strategy where we're going to have, it's in the same spirit of the Condor and Butterfly, except we're going to make sure that if the market goes up too far and too fast, we're not going to lose much money. We're not going to lose any money. We're actually going to make money, and we won't mind it doing that. All right, we have to then manage the downside aspect. And that's what we're focusing on here. So this is kind of the theory behind this. Here's the outline in our mentoring course. Today I want to just give you an overview of a hedged bull put spread, but we talk about this strategy. We also then discuss the timing entries using the same technology I just showed you for the condors. I apply this also to SPX bull put spreads using that same volatility edge analysis that I just laid out for you. We talk about initiating a hedged bull put spread position and then how to manage the campaign and take profits. Okay, that's part of the course. Today, let's just go over an overview of a hedged bull put spread and what we're discussing here. All right, so here is a bull put spread, a credit spread, so to speak. We're coming out a standard deviation. In an option view, we paint the strikes pink that lie within a single standard deviation of the at-the-money price here. And then we paint the bars blue, or the contracts blue, if they are outside between the 1 and the first and second standard deviation. So what we do here is we do a bull put spread, in this case a 5 lot that's 20 points wide. And we're selling the contract here, in this case, for $787, buying this one for $620, collecting a credit then, in this case of $825 after commissions, so that no matter how far the market goes up, we would collect this amount. If the market comes down, that's fine, so long as at expiration we're above the 2090 mark. So long as we're above 2090, we're going to collect this whole 825 that you see here. And when we graphically analyze this, oh, let me go here. Here it is. When we graphically analyze this, you can see as long as we're above that 2090, okay, we're going to make the full 825, which is about a 9% yield. Okay, that's a wide swath of prices. No matter how far the market goes up, we make the full amount. It can come all the way down to 2089 at expiration, or 2091. We still make money there, 2090. Now, we certainly don't suggest that you put the trade on, close your eyes, and wake up in 30 days and see where it's at. All right, because you have an 87% probability of profit. Look at, you could lose a lot of money if you let the market go down and it keeps going down past that strike. You can lose upwards of 100% of the full original amount required here, and that's no good. So we have to manage this. One of the ways we manage it is by hedging that downside. Remember, we're going to manage the curve of the ball going to the right, right? In this case, the curve of the ball with the curve of the market going to the left. We're going to manage that and understand it. So what we do is apply what we call a hedge, and that's a 1-lot hedge, buying the at-the-money put, selling the next strike out, and creating a hedge here. So if the market does go down, this bear put spread kicks in and starts making money. And as long as the market stays between this 2180 and this 2090, as if it stays in here, you can actually collect the full credit of 825 plus the profits on this hedge. Not too bad. Now where we lose out is if the market moves up, we're going to collect that 825 minus the cost of this hedge, which leaves us at 477, which is a reduced yield on the upside, certainly. Okay, but this is a way of managing the move of the market to the downside as we apply a hedge like this. And here's what it looks like. If the market goes up, you could see we have the reduced yield. Instead of 9, we're at 6. But if the market goes down, we're making money on the hedge. We lift the shoulder on the left side up. And if it does expire at 2090 or ahead of that, we're going to make the full profit from the hedge plus the credit from the spread. That's not too bad. But look at this. It just works out so much better than just a straight bull put spread. We can superimpose these in OptionVue using the superimpose button. And a beauty of OptionVue is that we can get highly accurate numbers between t plus 0 and t plus 30. Watch this. I'm going to superimpose these trades as of 5 days out. I want to show you this. 5 days out, we can see that this is the hedged in red, it's the non-hedged in blue. And as the market goes down, we're not losing near as much money with the hedged as we would with just the straight bull put spread there. Look at this. Now I'm out 10 days. I'm out 10 days. If the market goes down 1.7%, look at this. I'm actually making money with my hedged bull put spread, and I'm losing a bit of money here with just the straight bull put spread. That's 1.7. Now, what if the market went up 1.7 to this? Okay, let's take a look. Okay, with the, let me switch colors quick. With the straight bull put spread, I'm making probably 5.5%. Okay, with the hedged bull put spread, I'm still making roughly 3.5 to 4%. So there's a difference here. But look at this difference compared to the difference on the downside. See that? Far greater difference on the downside than on the up. So this hedged bull put spread is showing you a big advantage over just the straight bull put spread. And this is one reason we like this strategy, and we show you then how to campaign out of it. And one thing we like to do is do a bit of back testing. We have various ways of managing the hedge and managing the bull put spread, and give you the full array of elements in terms of taking profits and campaigning like that. And one thing I like to do every week for all our mentoring students is I do an inside wire presentation. And what I do is I'm researching every week new strategies, new ideas. I'm back testing things. And so in this case, I take some of the elements of campaigning, and we're rolling out various back testing results. And here's one I did here just a few weeks ago on back testing at the hedged bull put spread campaign. And just some results that came up using our back trader data is that for the last year from of 2016, using some of the approaches, 91% winners as of then. And you can just see the here 91% winners, 22 total campaigns for last year, or for this year 2016, 13 consecutive winners at one point. We had a loser in there. And here's the equity curve for trading this particular approach, hedged bull put spread campaigning. And remember, we show you when to get in, what the technical parameters are, moving average, stochastics, then how to put it on and how to manage it. Annualized return of about 33%, not too bad. And you're not going to get 300-400% return. We're not rolling the dice on long calls, long puts. We're trading spreads. You're looking at the market, once or twice a day. It's much more, of a longer-term spread perspective rather than rolling the dice on short-term, long puts, long calls. These are hypothetical returns. This is something I do every week, is just show all our mentoring students, just results of the work we're doing at any given time. Okay? So at any given time also, you can call our office and find out the specials that we're running. Let me go back up here. Let me find this. Just a second. Let me go find this. There we go. At any given time, we're rolling specials out for purchasing any of our courses. Please call our office or look online, but give us a call. Let me see. Do I have I don't have the number. Oh, shoot, I didn't have a number here. Anyway, it's 847-816-6610. 847-816-6610. And you can call, find out from the folks here what the special is that we're rolling out for that given week or month. We'd love to hear from you. Any questions you have, I'd be glad to answer at this point. Just go to the chat feature, type it in, and click send. And that's our presentation for today. I hope it's been of some help. And again, we are in the business of taking folks from being beginning traders to intermediate, taking intermediate, making them advanced. We have money managers that have come to us for more help, looking for a greater edge. And I think with some of the new technology we're rolling out here, we are able to deliver an edge really that no one else in the market is attacking right now. And that is using price analysis to determine entry points more favorable for Condors and Butterflies than normal. What's your stop loss on both the strategies? Well, we definitely have a stop loss in the Condors and the put and the hedged campaign there. In the Condor, we like to limit it to having what we call a delta stop getting hit twice. If we have a delta stop that gets hit twice, we're going to abandon the campaign and stop. In the hedged bull put spread, we have a dollar amount instead, okay, in the campaign. And so that we want to try and keep it to 2 to 3 times what we're trying to make. But the thing is in those hedged bull put spreads, and this is what I've pointed out to you before. Where do we go? Let me go to the right thing here. All right. Is that the right one? No, here we go. You know, you just want to make what's nice here about these hedged bull put spreads is that, and we talk about this in the context of our condors and hedged bull put spreads, is that we really want to avoid this cliffside here where you can really start losing several times what it is you're trying to make. And once you have one of these fat losers, well, what? You'd have to trade and have profits for a whole year before you make it up. And we don't want that. We want to manage that. It's very important that you manage that aspect of this. And so we, in the hedged bull put spreads, we like to speak of it in the context of what it is you're trying to make on this, on any given campaign, and manage this so that you never really challenge the market to go down and come back. And that's what I mean, there's folks even running advisories that just play the probabilities. The market come flying down, and they're playing the fact that the market is now oversold and just has to come back, right? Well, we know that it can keep going down, and you can actually lose 100% of your requirement here. So we don't ever want to tempt the market to do that. No professional option trader does that that's been around for any length of time. All professional option traders that have been around a long time, like ours have, they manage the risk ruthlessly is the best term to use, and that's what we teach. All right. Okay, folks, thanks so much for joining. Okay, when do you determine to initiate the hedge bear put debit spread? At the same time, Stephen. We put on the spread, the hedge, at the same time we put on the other one. Okay, we initiate both together. We initiate both together. All four legs are initiated at the same time. Yeah, we don't leg into it in that sense. Folks, thanks so much for joining us. I really appreciate it. Keep watching your Discover Option emails for more little classes like this. And again, if you're at all interested in mentoring and what we offer, please call us. We'd love to talk to you about our curriculum and even customizing it for your needs and where you're at. That's 847-816-6610. Thank you. Take care. Bye-bye.